I will go ahead and pass it off to our director, John Bradley Jackson. We also call him JJ. So JJ, why don't you go ahead and tell us a little bit more about yourself, and feel free to present whenever you're ready.
Yeah, very good. So in terms of rules of engagement, I'd like to have a conversation rather than a one-way speech. So I encourage questions, a good argument now and then. If you're not speaking, I would request that you mute your phone, keep the background noise out, but otherwise you're welcome to join. So I'm kind of a local product, grew up in Orange County, spent some time in Silicon Valley long ago, actually in the 80s. And it was a terribly exciting time in my life. I saw startups and that became multi-billion-dollar companies very quickly. It was just a great time. I leveraged that and I did a tour on Wall Street, helping companies go public. And there I learned about greed with a capital G. And I was kind of like a Boy Scout amongst gangbangers, is the truth. I pivoted during the dot-com bubble, and I ended up teaching part-time at the university, I'll say Fullerton. And lo and behold, I had a kind of a new career path. So today I'm a full-time professor teaching entrepreneurship, director of the Center for Entrepreneurship, and co-founder of the Incubator with Philip. I also started an angel fund back in 2017 called Titan Angels, and I'll talk a little bit more about that. So let's see here. I'm going to share my screen. And you can all see that, is that correct?
Yep.
Okay, all right. So I wanted to talk about funding, and this slide is repurposed from the classroom, and it talks about the different types of funding that's available, and any question about those is appropriate, okay? So a few vocabulary lessons. So a startup, we use that word all the time, is actually wants to be a company, but it's not yet. And the startup is still trying to figure out the problem, who their customer really is, then how they're going to make money. So typically they are pre-revenue, right? So that's the startup world. And the next step is you become a company. Well, what does that mean? Well, you know what the problem is pretty well. You've figured out who your customer is, and you've started to convert. You've got a business model. And so you're in the early stages of revenue and hopefully starting to scale. So that's a company. And I do find myself using the two terms interchangeably, but that's the strictest definition. So here are some stats. You won't believe this, but in 2021, 5.4 million startups were begun. And that's a business start. And like the basis of that is the creation of a DBA, doing business as, going forward. And so during COVID, a lot of transition. A lot of people said, I'll give it a shot. Now, here's an amazing stat, which most people don't know. Nearly 80% of startups are self-funded. Now, that 5.4 million startups, that's on a unit basis, and that's everything. But overwhelmingly, people start it by themselves. Nearly 40% get funding from family and friends. We certainly will talk about this. But even more dramatic here is less than 1% of startups actually are funded by angel investors. I'll tell you what, you watch Shark Tank and you look at the Orange County Business Journal, you just believe that startups are just being flooded with money by angel investors. Not at all. And even more dramatic, 0.05% of startups on a unit basis are funded by VCs. So it is like a lightning strike to actually get money from a venture capitalist. So here's a visual that's talking about when money is found. And so I love the description here on the far left, Valley of Death. And that's, so you're a startup and you're trying to figure out how to take your product market fit, as Philip said, how to go to the market, and you want to create revenue, and it costs a lot of money to start up any startup. And so that's the domain of angels, friends and family, seed capital. And then when you start to get things to click and you become a little company, now you start opening yourself to other types of capital. By the way, if you go to TechCrunch or Angels List and you look at the successful startups, one of the key performance indicators of a successful startup that becomes a big company is the ability to raise capital. And so to get the pot of gold, to go public, to get acquired, whatever it is, it usually means many rounds of investors who are coming in and buying part of your company. The stats are overwhelming. Now, conversely, if you're unable to raise that capital, likelihood of success is very low.
I had a quick question for you, Mr. Bradley, if you don't mind.
Yeah, yes, sir.
When for each round of capital you raise for your company, does that automatically mean a dilution of your interest and they get undilutable shares, or is that flexible?
It typically means you're selling more. Visualize a pie, and every time you get a new investor, you're giving them a piece of the pie. So you are getting diluted. But the pie is getting bigger, hypothetically, because of this new money. So startups actually have many ways to create capital. And I'll be walking through all of these. Some are obvious, and we won't dwell on them too long. So one is bootstrapping or self-funding, and that's where you raid your savings account, your 401k. You use credit cards. Credit cards, well, I think they're great. They're probably the easiest form of financing that's out there. And if you have the ability to pay it back, there's nothing wrong. Randy, you have a question?
Hey, Professor. So my friend wants to join the meeting, but it says the meeting is locked. Is there anything he has to do in particular?
So I think Philip, go ahead, Philip.
Just unlocked it. Go ahead.
Oh, thank you.
So that's just the security to make sure that we don't get hacked. So credit cards are actually a viable way. It's pretty easy to get 5-10 grand of credit money from a credit card, and that might be the difference between the success and failure of your businesses. I met a serial entrepreneur once, and he had a technique, frankly, in negotiation when he was negotiating a lease, when he was buying a refrigerator for the office, whatever it was, he would express interest, and then he would say with a smile on his face, "Hey, could I have it for free?" And usually the other person, the seller or whoever it is, would kind of laugh, and it was disarming that this startup founder had the chutzpah to ask for it for free, and usually he got a discount. So how clever is that? So sometimes in life, you simply have to ask for it. But when you get down to it, bootstrapping means not spending money. So when you're in that early stage of the startup, do whatever you can to say no and not spend and not use up your precious cash. So one way to kind of fund yourself in a startup uh, is to consult in the industry where you want to start up your company. So what happens, you're getting on the job experience as a service provider, as a consultant, whatever it is, working with people that may be your potential customers. And in the process, you bring in a little cash, and that helps you validate your concept and maybe helps you build up your savings to actually do the business. Rather clever when you think about it. One of my favorite categories are the 3 F's. It's called family, friends, and rules. Now, you recall 38% of startups get their money from the 3 F's. Now, why do they do it? Well, it's easy in a way, as you hit up mom and dad, Uncle Charlie, your next door neighbor, and ask for money. Okay. And because they like you, love you, believe in you, they might write you a check. And so it's flexible, but it begs the question, is that a gift? Is that a loan? Or are they buying a part of the company as an equity investor? Truthfully, I don't like, careful if I say this, I don't like the 3 F's. And the reason is most startup founders are sloppy in their documentation on this type of money. And the root problem is they don't say whether it's a gift, a loan, or equity. So think about it. You get 10,000 bucks from Uncle Charlie, and he comes back 6 months later and says, well, I hope things are going well. Can I have my money back? Well, I guess that wasn't a gift, and I guess that wasn't an equity investment. It was a short-term loan. Catch my drift? So, and by the way, the best way to end those relationships is by doing a loan or a gift or equity with them. So if you can avoid this category of investment, I would. By the way, the term accredited investor has a formal definition, and that would be an individual who's got $1 million in liquid assets, and that means in their Schwab account, and it doesn't include their residence, their house, or they have a track record of making a few $100,000 a year for a few years. And the Securities Exchange Commission says that a person with that type of net worth and income, well, they get it that investing has risks. And then if you do business with accredited investors, it's the regulatory compliance issues are a little less. So just a note for you there. And by the way, Philip, I don't see the chat if I need to answer any questions. Another area that you could look into would be grants. And so grants are gifts. They oftentimes have conditions, but they're available from public and private sources. And there's all sorts of grantors who are targeting certain technologies, certain types of businesses, certain types of people. And they want to support the initiative, in this case, a startup activity. So you could be a single mother, you could have a certain type of educational software, but it's just got to tree up to desires of the grantor. Now, the downside with grants is particularly the government grants require very extensive proposals, typically that are written in Shakespearean terms. And what I mean by that is they're looking for reasons to toss out the proposal. So they're looking, at this case, it's Alex's proposal. And they're looking for comma splices, errors, and things. So that's how precise some grantors review grant applications. Not all. Now, on the other side of the equation, many grantors will say they just don't get sufficient qualified applicants. And that might be because their specification is so tight, or simply they just don't get enough of them. So grant sources, well, there's public and private grants. And here are some links that you can dig into for, these tend to be government grants I have in front of us here. But you'll find they're a little seasonal. So many are built around the end of the calendar year or the beginning of the new calendar year. And you kind of have to think in advance, oftentimes 6 months in advance, to go through some of these processes. The private grants, some of them are quick turn. And, you know, I've witnessed grants that are applied and you get awarded within 2 weeks. So that's also possible. Surprisingly, contests are a great way to fund your business. And there's one coming up. So the 5 Cal State universities in Los Angeles, plus Cal State Fullerton, is having an event on May 6th. It's at Long Beach. And believe it or not, it's going to have $130,000 in prize money. And there are only going to be like 6 applications or so from each of the state universities. Now, the reason I put up this photo, that's a former student of mine. Love him to death. His name's John Chi. And John was my student about 8 years ago. He's a graduate student. And he's not in the room right now, so I can talk about him. He may have been the single worst presenter I've ever encountered in the classroom. And excuse me, my word got tangled up in my chair here. So now I'm untangled, pardon me. And John was a mature student. He was probably pushing 40, and he'd stand up in front of the class and giggle. And it really didn't help his pitching. But over time, with a lot of coaching, he became better presenting his pitch deck. Now, what happened is he got really good, and he was winning contests. And John won approaching $100,000 by participating in every pitch contest he could for about a year and a half. And then that money went to helping him start his company, Sonova Life Sciences, which is now scaling. And someday it's going to be, $100 million company. I kid you not. So the contests are a really easy way if you've got a good concept and you refine your pitch. I highly recommend them. Incubators. So an incubator, is there a question?
Yeah, I'm sorry to interrupt you, but what was that student's or your previous student's company like doing?
Stem cell therapy.
Oh, interesting. Okay, I see.
Okay. So it's patented technology that involves service as well as a box that helped isolate stem cells. Returning to incubators, an incubator is a place where a startup goes to get help to move forward, let's say, to determine product market fit, to get ready for funding. And there's a Tech Coast Angel, a friend of mine, his name's Jack Ty, and he said unequivocally that incubators improve your chances of funding. So if you're a startup and you're in an incubator or you've done an incubator, investors say, well, that individual is coachable, they know what's going down, and that startup is more likely to get money. So what's cool about incubators is investors stay in touch with them. They're looking to invest, so the incubator knows who has money. Now, some incubators are nonprofit. Others are actually disguised investors themselves. And so an example of that is Y Combinator. It's probably the single most famous incubator. And there's only a 1 or 2% acceptance rate. The bar is really high to get in. But if you do, they're going to hand you possibly $125,000 in seed capital. That is pretty neat. Now, in exchange, they're going to want 7% or more equity in your company. I don't know if you that 125,000 could really move you forward. 7%, is that expensive? It kind of depends on your attitude, but it's pretty good for Y Combinator. By the way, Dropbox came out of Y Combinator. So I want you to think about what is 7% of Dropbox. That is a lot of coconuts, my friends. By the way, Philip talked about the incubator, and I'll just give a brief commercial. We're early stage. We don't discriminate on the industry, so we're a mixed use incubator, but we are looking for highly scalable startups to join our incubator. We're looking for good people who want to make the world better. So we will turn away the racketeers, the gun runners, and the drug lords. Sorry. Now we'll provide mentors, a student team. We do charge a tuition. We don't take equity, right? But we're going to school you, and in exchange for that, we ask you to help us keep the lights on. Another category you hear a lot about is crowdfunding, and there are at least 5 types of crowdfunding, and I'm going to walk through these. It's reward-based crowdfunding, equity crowdfunding, crowd lending. Most of us haven't heard of it. Donation crowdfunding and royalty crowdfunding. Oh my God, I didn't realize there were all these many types of crowdfunding. So this is the one we typically encounter, and you see it from Kickstarter or Indiegogo, and they say, if you give me, the company, $25, I will give you a t-shirt. And if you give me $100, I'll give you a t-shirt, a coffee cup, and some ground coffee, whatever it might be. And so it's kind of like a trade. And this is promotional in nature, mostly. Although I had a former student raise $150,000 using this type of crowdfunding technique. Then there's equity-based crowdfunding, relatively new on the scene. And the Securities Exchange Commission has said, okay, we will let the small private companies sell shares to investors. And you could buy as little as maybe 1 share or 50 shares, something like that. And what has happened over the past 7-8 years is we have a new category of equity crowdfunder out there. The one that I know best, so the Start Engine, AngelList, Seed Funder, WeFunder. I know AngelList the best. And so what happens is you can effectively enroll your startup, and it gets promoted to angel list investors. And so it's a way to create capital. And I'm actually investigating placing a fund on angel list right now that will raise money for a single startup. So there's a lot of ways to do this. And I think the rules of engagement are just emerging. But I think this is an exciting way to get access to investors that you would normally get to meet. Donation, yeah, that's the one where my kid's baseball team needs uniforms. Could you give us some money? This works, all right. And if there's a strong emotional hook, it can work and work really well. Okay. Crowd lending, again, most of us have not heard about it. This probably applies to companies that are scaling, but in effect, lenders jump on the bandwagon. They're part of the crowd. And what they'll do is they'll lend money, a short-term loan, at a above market interest rate. Okay, so they're going to make a little more money, but as a startup, you're probably not considered lendable, so don't bother. Another one is a royalty-based crowdfunding. So think about this. They want to invest in your company. They're not asking to be an owner, but they want a cut of the action on your future income. It could be based on revenue, could be based on income, more likely income. And so that'd be a very long-term relationship, quite potentially. So crowdfunding stats.
Quick
It's
question
really
for you.
huge. Yes,
Quick
sir.
question for you, Mr. Bradley, on that last slide there. Is there a time limit on your future stream of royalty income, or is that negotiable?
Yeah, it's probably deal by deal. So having not done it, I'm just reporting what I've learned. So that's the best answer I could give you. Crowdfunding stats, it's huge. 17 billion last year. Crowdfunding is growing pretty fast. The average amount raised by a campaign was $824. Yeah, there are a lot of crowdfunding campaigns. $825, I don't know. So that includes all the baseball teams and everything. So sometimes averages lie, but it also says, holy, there are a lot of competition in crowdfunding. But if you have video in your campaign, you're more likely to do better. If you're following up with your potential investors or donors, however you want to categorize them, you're probably going to do better. The average success rate of crowdfunding campaigns is 22%. So what they're saying is nearly 80% of the time, the campaign does not reach goal. Now, what does that mean to me? It means that you could really waste a lot of time and energy on a crowdfunding campaign and have it not pay off. Okay, we're going to move forward. And another way is, so now you're an early stage company and you've got customers, vendors you're doing work with. Guess what? They could be a source of capital because they want you to win. They want you to be successful because they're a partner of yours. And candidly, there's less formality. They could be a better, smarter investor for you as a partner. Very definitely worth pursuing if you have significant collaborative relationships with partners. Seed investor. Now, this is where I start slicing hairs and have to bear with me. So what's a seed investor? Typically, it's an individual investor, and they invest at the earliest phases. honestly, they can be easier to work with than an angel network or certainly a VC. They prefer to be local because they want to eyeball you. They want to get involved and they want a piece of the action. They believe in you. They believe in your business concept. Now, what might they invest? It could be $10,000, $100,000, $500,000. It's just all over the map. But what I can tell you is they want a significant piece of action and they want to be involved.
Oh,
So, question? All right. Seed funding firms. So previously was an individual investor. So you actually have companies that target early stages. And this is where things get a little murky. Actually, I might argue that some of the incubators in our neighborhood are actually seed funding firms. That's really their business model. And I'll talk
maybe help
about,
ourselves to one of those.
Oh, absolutely.
so Alex is walking around. There he is. Seed funding firms can be found. They're in our local market. There are a lot of them up in the Bay Area, by the way. So let me continue, and then if you want to get some clarification. Here are the top seed stage investors. You see Y Combinator is way up on top. And we think of them as an incubator. I mean, really, they're investors. That's what they do. And you look at this list, many of them are in Silicon Valley. A few of them are located down here. An angel investor. Okay, well, it's somebody with money who is interested in you and your concept. Overwhelmingly, they invest in exchange for equity. So they're going to buy a slice of that pie that I was talking about. They may or may not want to be involved in your business. So they may be passive investors, and they can invest a little or a lot. I've seen angel investors, for 10 grand. I've seen angel investors for approaching $1 million. It's same guy, just more zeros, I guess. They're looking for a really strong return on investment. It's typically someone who describes himself as an angel investor. It has a portfolio of startups that they're investing in. And so let's say they have 20 startups in their portfolio. They understand that over time, there may only be 2 or 3 of those startups that really knock the ball out of the park. There'll be a whole bunch that kind of move slowly, do okay. And there'll be another group that tank early. So they're always looking for that startup that has great potential. Now, there are angel networks and angel funds. So angel networks would be a community of like-minded individual investors. We're going to talk about a few of those. And what they do is they hear pitches, and then the individuals say, hey, count me in. There might be 30 people in the room, and you might get 4 people who say, I want to invest. And then those 4 investors invest as individuals. A fund is a group of investors that invest in a fund, and then the fund itself invests. There are fewer of those around. So if you're an individual investor and you call yourself an angel, it kind of makes sense to hang out with other like-minded people. Collectively, you could be smarter. Also, you'll see more deals that way. It should be mentioned that usually an angel investor invests once in a startup because they're investing their own money. and they may not have access to other capital. So the expression would be seed and feed. The angel investor typically does not seed and feed, they invest once. By the way, the venture capitalists, who we'll talk about next or soon, invest other people's money and they have more access to capital. So a venture capitalist might put $2 million into a deal and come back in a year and a half and put another 2 million because business is doing well and because they have access to other money. Now, in our backyard is Tech Coast Angels. This is, as I understand it, the largest angel network in the United States. They're 25 years old. It's kind of interesting here. So these stats actually say the business is harder than it sounds. So they've invested in 500 companies in 24 or 5 years. Okay. And of those 500, only 11 went public. And almost 80 have exited. Wow. So they've invested in 500 companies and 80% of them have not had an exit or they failed. So you can see they're angel investors are taking quite a risk. So anyways, these are good people. It's a laborious process. I don't know if anybody in the room has ever presented to Tech Coast Angels, but you can be turned away with recommendations and go back and forth 5-6 times to determine if you get money from them or not. There's another local group called Pasadena Angels. They're a little kinder and gentler. They've been around a long time, and they are a good source of capital, and they'll partner with the other angels. Titan Angels, you may not have heard of that. It was founded 4 or 5 years ago, and I happen
I've
to
been
be
here.
the
So what's your name?
Diane, can you turn off your audio, please? Unless you have a question. Titan Angels invest in early stage startups. We're a small group, we're growing. We've got about 30 investors. We've invested in 28 local startups, most of them local. And we'll invest smaller amounts and we meet once a month. So this is a fund. So the 30 investors invest in Titan Angels, and the Titan Angels will invest in a startup. So what do angels want? First of all, they're looking for a coachable founding team, emphasis on team. Generally speaking, an individual entrepreneur is not fundable. So individuals invent products, teams build companies. So with the emphasis on growth, you need a team to get access to capital. There's a preference that you have IP, proof of concept. They want to know that the dog will eat the dog food. They don't want to invest in your R&D. They want to know what you propose actually works. They also are looking for a highly scalable business. And it breaks my heart, actually, as an investor, when I come across nice little businesses, that are going to grow year after year and make good money. But that's not an investment that I want to fund. Because I'm looking for businesses that'll be 50 million, 100 million, 500 million. A cool little $5 million business. Don't waste my time. That's not what we do as investors, as angel investors. So typical pre-money valuation is at least $1 million. I would say most of the startups I see are 4 to 6 million in pre-money valuation. And as the investor, we're looking for a really aggressive term. It says 5 to 7 years. And if you go to TechCrunch, it'll tell you that the typical exit, that's where the ROI is made, is 7 years after funding. It takes a long time to build a company, scale it, and then get an exit. Philip, I see we have 11 comments. If there's anything I need to answer, just let me know.
Will do.
Okay. And then there are other angel networks in our community. So you can check these out as well. Now, one of the questions I get asked, where are these people? Well, they go to pitch contests. They go to events about raising capital. They're very social because they have to be. And you can meet these people. And it's far better to meet them prior to pitching, because then you might actually have an advocate who can help you in the process. Venture capital. So this is the stuff that's made of movies, right? So these are actually professionals who invest other people's money. Now, they might actually have a little skin in the game, but overwhelmingly, the money they're investing comes from pension funds, banks, corporations, churches, anybody who's got a lot of money who wants to have a high risk, high return portion in their portfolios. Now, the bar of what a VC invests is actually really exploded. I have a friend who's a VC in West LA, and his minimum check that his VC firm writes is $10 million. I think the bar goes down as low as 2 million, because sometimes the VCs like to go early stage. Most of them are preferring that startup that's got their stuff together. It's in revenue, it's got a team, things are working. And again, they will seed and feed, which means if you're doing well, they could be an additional source of capital. They do have this fixation with having the best team possible. It kind of makes sense if you think about it. It's like everybody has to have red socks, the right school, the right pedigree, right work experience. And so sometimes I think they obsess a little hard on that, but that's one of their major criteria. They want fast growing, giant companies. So you got to play in a big market. And they're looking for that aggressive return. Oh, you can go to banks. So, you know, there are commercial loans and then federally backed loans, which are called SBA loans. So Wells Fargo has commercial loans, and then they also have SBA loans. And so this reduces the risk for the bank. And if you're a company that's up and running with cash flow and has a couple years of sales with profits, you could qualify. Oh, by the way, they still want collateral. So if you default on the loan, you're going to have to give up your house. Hi, Kevin. You have a question? Kevin, you're on mute. Do you have a question? Or maybe that's just a high five. Okay, I'll move on. Private equity. So that's kind of a vague area. So it's a company, typically, that has money. And they're on the hunt for companies that are in transition. Maybe the company's run by an executive who is in ill health, is going through a divorce, needs to unload the company. And oftentimes what they'll do is acquire 2, 3, 4 of those like firms, right, that are in a fair amount of distress. So they'll take those 4 firms and do what's called a roll-up. they take the 4 firms and turn it into 1 firm. Okay. And then they start reducing cost. So we've got 4 VPs of marketing. Guess what? We don't need any of you guys. Bye-bye. They have 4 CEOs. No. We're going to run the show. You guys are done. And so you see what they do. They combine human capital, channels of distribution, and then usually what they do is they turn the company around after putting some new lipstick on it, and in maybe 18 to 24 months. So it is a rather brutal form of investor who gets really into it. And so maybe they spend $30 million on the 4 firms that they acquired, but they hope to sell it in 2 years for 60 million or 90 million. These are kind of big time sharks. And if you have to do an exit, this is one way to do it. Uh-oh, speaking of sharks, hard money loans. So once again, this is someone who has money, and you know what? They'll do you a favor. Okay. You need 100 grand. All right, here's 100 grand. And here's what I want. I want you to pay me back in 12 months. And I might need your house as collateral in case something. And then, because this is a high risk loan, instead of a commercial lending rate of, let's say, 7%, all I ask is 18%. That's okay. And then when we get to the year, I have the option to convert to equity. So if things are going well, all right, I want to take my $100,000 and turn that into an equity relationship. So are these bad guys? No. Are they savvy business people? Hell yes, they are. And they provide a valuable service, and they're going to make their money quickly in the short run, typically. So hard money lenders or loan sharks also can be angel investors. They're just out there, and it's another way for them to do a quick turn business. Okay, why don't you just go public and skip all this crap? Okay, you could do that too. And so it is possible for a pre-revenue startup to get listed on the OTC, the over-the-counter marketplace, and go public. All you are is a brochure, maybe some IP, and you can sell stock on the public stock exchange. So that is exciting. It costs some money to do it. It could be as much as 100 grand, and then there's got to market. The tricky part is if there are any OTC investors in the room, there are about 10,000 companies listed. How in the world does the investor find you? That is the riddle. And so sizzle, the sensation of your startup, that is everything for that early stage public company. And so it's a lot of promotion, and there's a lot of risk. So actually, you could go public, and let's say you raised $1 million and you were $1 a share. It could be that your share price could get pummeled. And at the end of a year, your stock value could be a penny. Literally can happen with the buying and selling that goes on in the public markets. So this is a high risk scenario. It might be access to capital. It's not for everybody. So now we return to the startup financing cycle. And most of us in the room, we're looking at that first rectangle where we're trying to create revenue, trying to create a profit. So we're going to lean on the small investors. Once you start to scale, cash flow, and your potential is significant, then you can start looking at the more sophisticated professional investors to help you fund your growth. And the way they get paid back is if there is an exit, a capital event. And I can count the capital events on one hand here, and that is you go public, it almost never happens. You get acquired or you merge, highly likely, or you go bankrupt. So not exactly the exit that the investor was targeting, but that is another way that they get to exit. So I'm going to open it up to questions now, and otherwise I have no problem if you reach out to me at Thornton at this contact. Philip?
Great. Thank you, JJ. Really informative. I really enjoyed this presentation. We do have some people asking for the presentation. Will that be made available later?
Yeah, no problem. I will forward it to you, let you distribute.
Okay, perfect. Yeah, that's a few people were in the chat and asking about that. We do have another person that asked about if there are any VCs that do $1 million in LA. I have a feeling that might be more angel investment, but JJ, maybe you can comment on that one.
Yeah, again, we can slice hairs here because there are venture capitalists in Los Angeles who invest at lower levels, right? And in fact, in the early stage startup. Now, most of them want to write bigger checks. There is a subcategory. If you look it up, it's called micro VC. So they're above an angel, right? But they're not a legit VC. So they're doing a lot of investments. So there are micro VCs. The VC that I was referring to earlier, based out of West LA, is Composite Ventures, but they have a consumer tech focus. So one thing you'll discover is that these investors oftentimes specialize, and there's some good reason why. If you have big money to invest, or even small, it might be better to focus in on a segment that you have intimacy with, knowledge, because you have contacts, right? And there can be leverage in limiting your investments to a certain category.
All right, great, excellent.